If you're working in private equity, you'd have often come across the term waterfall distribution. Let's understand in private equity what is the meaning of American waterfall and European waterfall. I'm your learning partner Sushila Hariharan, and if you're interested in careers in investment banking operations, corporate actions, ODC derivatives, and foreign exchange, do subscribe to my YouTube channel where we provide individual videos on specific topics. So you got to see all videos on that topic, which has been classified into playlists so that it's easy for you to read about various concepts. Okay, private equity funds, as we already know, are pools of funds that are contributed capital by investors and LPs. The GP then pools the funds, okay, and makes investments from the pooled funds into unlisted equity. So the biggest difference between private equity and a mutual fund, for example, is that private equity invests in unlisted stocks, mutual funds invest in listed stocks. So do hedge funds, even they list in listed stocks. So even they trade in listed stocks. So private equity funds are a separate category of alternative investments wherein the trajectory for the growth of the fund itself is extremely J-curved shape. And there's another video I'm going to explain what is the meaning of the J-curve in private equity. The limited partnership agreement between the GP and the LPs, because there could be multiple LPs and there will be multiple LPs, describes and defines the roles and responsibilities of capital commitment and capital drawdown. So clearly articulates at what points of time capital is going to flow into the fund and capital is going to come out of the fund. It also explains the fee structure and profit distributions between the limited partners and the general partners, and hence LPA is the defining agreement in a private equity fund. If there's any case of dispute or thereafter, any case of conflict or resolution required for disputes and disagreements between the LP and the GP, they have to go back to the LPA to find out what is mentioned over there, what are the clauses, and therefore this is a very, very exhaustive document. The limited partnership agreement also describes the distribution waterfall. The distribution waterfall is a framework for distribution of profits between the LP and the GP. Look, when a limited company makes profits, they distribute the profits to the shareholders by way of dividends. They plow back the remaining profits into the company for further growth. In the case of mutual funds, they distribute the profits to the unit holders by way of dividends to the unit holders, right? But in the case of private equity funds, hedge funds, and all these pooled funds, the profits have to be distributed back to the investors, okay? They cannot be reinvested back into the company, into the fund itself, unless specifically stated so. And why would they do that? Because limited partners are making large sacrifices. Literally, they're not earning money for years together. So they are unlikely to do that. So they want to encash large profit distribution. So there's big difference even in the accounting methodologies adopted for defining the framework for distribution of profits between the LP and the GP, between the limited partner and the general partner, and this is in a tiered progression. Okay, what do you mean by waterfall? Waterfall methodology is a cascading methodology. When one bucket gets full, the water flows to the next bucket. When the next bucket gets full, the water flows to the next bucket. And when the third bucket gets full, the water that's still left to flow over then goes to the fourth bucket. So the fourth bucket can get either too much water, more than what its bucket share is, or it can get nothing at all. Okay, so hence the waterfall methodology really truly compensates both the LP and the GP for the risk and the sacrifices that they have taken in their investment decisions. So let's understand the 4 tiers. The first tier is return of capital. The second tier is preferred return. The third tier is carried interest, commonly called in PE language as carry. And the fourth one is splitting of the final distributions. Let's analyze each one of them. This is point 4 in the video. The first one, 4.1, return of capital. The capital is returned to whom first? In this case, the capital is returned to the LP. The limited partner recovers the initial investment. Once the limited partner, so limited partner is external to the private equity fund because it's only contributing capital, it's not having an active role to play in decision making, in investments, in asset allocation, in hearing pitch stories, etc., etc. So the limited partners have contributed capital and they are going to get that capital back. So this is the first stage, return of capital. This tier is filled. Then we move on to the next stage, which is the next tier, that is the preferred return. Preferred return is after the investors, the limited partners have got their initial capital back, they need to get their hurdle back. They need to get the profits up to the hurdle rate. Okay, this is called as the preferred return. Once this tier is filled, the third tier is carried interest. Now, most of the allocations that are due to the limited partners are done with, and carried interest now belongs to the GP or the general partner. So after the limited partners have got their initial investments, after they have been able to get the returns up to the hurdle rate, whatever is left over belongs to the GP. Okay, the rest of the allocations, that is carried interest and the profit distribution, is largely belonging to the GP. The GP earns carried interest. Typically, it could be about 20% of the profits. After this tier is filled, there is a splitting of distributions between the LP and the GP, typically in the ratio of 80:20. Okay, 80:20 between the LP and the GP. The distribution of profits takes place between the LP and the GP. So this is how the waterfall cascades, waterfall flows, waterfall distributes tiers across. The two methodologies that are normally adopted by most of the private equity firms is American waterfall methodology or European methodology. The American waterfall methodology is a deal by deal profit. Let's say the PE fund makes an investment into 3 different companies in the year 2017. They have exited one of the companies in the year 2024. Once they've exited that company in 2024, the profit is distributed amongst the LPs and the GPs. Is this clear? What about the other 2 companies? As and when they exit, they will take a look at how it has to be distributed. So GPs earn carried interest before LPs can recover their initial capital as well. In fact, it's almost side by side. Okay, so there is no sequencing, there is no tiering over here, because once the deal is the investor exits the company, the profits are distributed directly between the GP and the LP. Obviously, GPs love this methodology because they are not having to wait for those tiers 1 and tier 2 to get filled up before they can get it. The American waterfall methodology is really preferred by the GPs. The GPs earn, the deal by deal profit, and the GP earns carried interest even before LPs can recover the capital. That is, tier 1 GP earns capital plus LP recovers the initial investment. What happens if the investment that was made in 2017 in 3 different companies, company A, B, and C, and company A exited in 2024 at a very high profit for the investor, but company B and C didn't make any profit, so therefore there is a loss. So as far as the fund is concerned, they've made profit in one of the investments as a pooled concept, but they have lost money on the other 2 investments. This brings us to the topic of clawback. Clawback is the excess profit that has been given to the GP because the GP got the capital before the investors could recover their capital, right? And therefore, the GP has to pay back to the LPs their money so that the initial investment is recovered. Alright? So, clawback provision is a provision wherein GPs return back excess profits that have been made in one particular deal but not made on the pooled fund, and therefore it's called as a clawback. A European waterfall is a consolidated deals profit distribution, the one that I described in 4.1, 4.2, 4.3, 4.4, wherein there's a methodology followed of giving the first two tiers to the limited partners, the third tier to the general partner, and the fourth tier shared between the general partner and the limited partner is the European waterfall. This consolidated deal, the LPs recover the initial investment plus the preferred return. The GP earns only after LPs are paid out, and therefore most European waterfall methodologies will have no clawback provision. Is this clear? So obviously limited partners loves this European waterfall methodology because it gives them priority over GPs at the time of profit distribution. Thank you so much for watching in.